Hi, this is a Sabre Limited Expert Series video on FIFO and standard costing. Should I use standard or FIFO costing? It's a question I get a lot, and I want to try and answer it. It's a little bit complicated. It gets a little accounty. There's some debits and credits in here. Don't scare anybody, and but hopefully it's fairly easily understandable. I'm going to use an extremely simple example. So I'm Rob Jolliffe. I'm a Microsoft Dynamics Business Central expert, and particularly I'm an expert in manufacturing. I am not an accountant, so please forgive me if any of this is slightly wrong. I'm going to get my accounting professionals to double check the information. A couple of assumptions I'm making. You are a manufacturer if you're watching this and you're interested in knowing and understanding FIFO and standard costing from a manufacturing point of view, and you're using or you want to use a mid-market ERP system, and that's why you're asking the question. So who should use standard costing? All right, what kind of business should use it? So as a general rule, I find that standard costing works in high volume manufacturers. And typically they are doing similar products repeatedly or repetitively. So you wouldn't want to use standard costing if you were doing very different products all the time, even if you're doing a volume. So you're regularly doing products, you're doing lots of different products, but they're different all the time. You're not repeating the same part on a regular basis. And you would have very, very little product variation. So your products wouldn't be being redesigned and re-engineered with any regularity. I don't think that would be a good fit for a standard costing. Who should use FIFO costing? Now, FIFO costing is also called actual costing sometimes. There's other types of costing. There's average costing and LIFO and specific, and I'm not going to get into any of that. I just want to talk about FIFO or actual cost and what kind of businesses should use that. So usually a more of a low volume manufacturer, and by low volume, we might be talking about 10 to 20 parts per product run or 100 parts per product run per production job. That might be low volume, or one. Engineered order manufacturers, job shops sometimes just do one. You would have many different types of products that you're making, and by types I mean like the actual physical product might be a lot of different products. And you typically also you want to do job costing, but you have a high product variation. So you're not making exactly the same product in huge volume over and over and over again. You're not an automotive stamping company where you're stamping out millions of the same parts over the course of a year. Okay, let's look at an example of FIFO versus standard. This might help, or might even make it more confusing. All right. We have a part 101. We manufacture part 101, and it costs us, we've calculated an engineering cost of $50. We have a bill of material, and we have a part A that goes into making our part 101, and that is $25. That's the standard cost of that, or I don't want to use standard. Let's say that's the expected cost. That's what I usually pay for it. That's been the market price for a long time. So when I designed it, it was $25. And it takes about an hour of assembly to manufacture the part. And it's $25 an hour. Just barely simple, no overheads, just $25 an hour, very basic. So just imagine that recently I purchased some part A's. I was out of part A, so I just bought some new part A, and they were $30 a piece when I bought them, not $25. And just because of some production problems, or perhaps because our engineers were a little exuberant and it doesn't really take an hour to make the part, it took 1.4 hours to make each part. So I'm going to have part A as FIFO. I'm not going to have part A as standard cost. My part A is $30 per part, which is what I just paid for it. So it's in my system at $30 a part in my FIFO layers. Part 101 is either FIFO or standard. Let's take a look at it. The cost to make 10, the actual cost, it really cost me $650 to make 10 of them. 14 hours of labor, 1.4 hours per part at $25 an hour is $350. And 10 of my part A materials at $30 a part is $300. So it's $650. That really happened. It's really cost me $650 to make it. So our item cost $65 to make. Now, The standard, if I'm using standard cost, was 50 because that was the cost that when I engineered the item, it should have cost me to make it according to the engineering. It really cost me $65. So let's just take a look quickly at what happens. I am going to do a FIFO inventory GL entry. I'm going to debit my inventory of $650. I'm increasing the value of my inventory by $650. Inventory is an asset. And I'm crediting my WIP $650. So I at some point in time in the past, I'm not going to worry about all of those transactions. I put $650 in WIP, and that's a combination of labor and materials. And I took it out and put it into inventory later when I received the parts. So that's the inventory transactions for FIFO. My FIFO inventory subledger, if I go look at the subledger for inventory and I look at the parts, I have part A that I used 10 of them and they were $30 each. So that was $300 of inventory that I used up. And I put my part 101 into inventory and they are $65 each. So now I have $650 of part 101 in inventory. If I look, if that's the only thing I have in my inventory, the $650 of inventory for part 101 matches the $650 debit that I did to my inventory account. Now, let's look at standard cost. When I do my standard cost, my inventory goes in at $500. So my debit to inventory is $500. My credit from WIP is still $650. I had $650 of WIP costs to make the part. That's what it really cost. The real world, adding the costs up with a calculator, it was $650. So the $150 goes to my cost of sales. In the month or the moment, the day when I made the part, I lost $150 making this part. So I increased my COGS in the month. I may not sell it for another 6 months. It doesn't matter when I sell it. My COGS went up by $150. Now, one important note is that COGS got blended in with any other parts that had a standard cost increase or decrease. So if I go look at my COGS account, it's very hard to figure out exactly where all the pluses and minuses come from. I'm going to see an aggregate number. In my inventory subledger for my standard part, I have $500 of inventory value of my part 101, which is matching my inventory GL account. So what I'm losing visibility of in my standard cost is I'm losing the visibility of exactly which particular inventory subledger entry had the $150 extra cost. And if I'm making something very, very repetitively, and so I'm really working on making sure that I'm controlling and tightening up on my purchasing processes to make sure I'm getting my raw materials at my standard cost or the expected cost for raw materials. And I'm tightening up on my production process because it's very repetitive. I'm doing the same thing over and over again. This is really a good way of managing a breadth of different manufacturing that I'm doing. So I'm making a lot of parts of very similar. So I have a low product variability, but I have a really high number of production. I create or produce a lot of those individual parts all the time. Then the COGS just begins to have pluses and minuses in it. And if I notice that the COGS continue to go up, the variance account, there's a specific account usually used for variances. As I see it start to climb, then I know I have to jump in and see, is my purchasing department having troubles? Is my machine maintenance a problem, etc. Where if I'm doing the FIFO, then I'm more able to look at it on an order by order basis. Was my order, my production order efficient or inefficient? Why was part 101 in this particular case more expensive than expected? And there is no blending of the extra costs. So the next time I make part 101, it may come in at the $50 and I may have another record for part 101 that was at $500. So really, for manufacturing companies, the difference between using the two often comes down to whether or not they want to do a job by job or production order by production order analysis and find out where the costs come from. Now, an interesting thing is I can do that job by job analysis with standard cost. So standard costing does not prevent me from doing job by job analysis. But the other thing that standard cost does not do is it does not protect my GL accounts from fluctuations because of errors that are being made in my production reporting. So if I report errors in my production, they are going to end up in my COGS. They won't be in my inventory, but they'll be in my COGS. Now, what some clients do say is, but I don't think my inventory should have been $650. There's a problem there. I want standard costing so I don't see those fluctuations in inventory. The only trouble with that is, A, you're going to have it on your income statement. So if you show the bank, well, I've been losing money because I've been moving all of this into COGS, but look, my inventory is what I expect it to be. That's not necessarily a good thing. And the second thing with standard cost is that in those cases where you have a lot of errors and there's a lot of problems, standard cost kind of hides it. And then you don't see what's going on and you never get in and try and fix it. Whereas if you have FIFO costing, if you have actual costing, and you are analyzing your inventory as you're producing it, and you're spending some time on cost accounting, then you can see which production orders caused you a problem, and you can drill into them fairly quickly by knowing that I expected part 101 to cost $50, but this time it was $65. And that's very easy to report on. So which one you want to do should depend more on what your production processes are and what type of parts you make regularly than how easily you want your, or how smooth you want your inventory valuation to be on your balance sheet. Because you're just going to have a reflection on your income statement that's going to make your income statement look terrible if your inventory would have looked terrible. So as always, check out the links in the description for other videos and articles related to this video, and subscribe and follow us because we're trying to release new videos weekly. Just click on the subscribe button in YouTube and the little bell to follow us and be alerted whenever we release a new video. To contact us, we're Sabre Limited. Reach us at our website, www.sabrelimited.com. You can send us an email at sales@sabrelimited.com, or you can reach me on LinkedIn at linkedin.com/in/Rob Jolliffe.